Hey everyone, welcome back to Corporate Decoder. Today we're diving into the financial world of Las Vegas Sands, a company synonymous with casinos and resorts. It's not all glitz and glamour when taking. This isn't your typical quarterly report, it's an 8K, which means Las Vegas Sands had something important enough to tell investors right away. Specifically, they're talking about selling some debt, which is basically borrowing money. The company entered into an agreement to sell a whole lot of notes, which is a fancy word for bonds. They're planning to sell $1 billion in notes that will be due in 2028 and another $500 million that will be due in 2030. Think of it like taking out two big loans that they need to pay back in a few years. For the $1 billion they are borrowing, they will be paying an interest rate of 5.625%. The buyers of the notes will get paid 5.625% every year until 2028 when they get the whole $1 billion back. For the $500 million they are borrowing, they will be paying a slightly higher interest rate of 6%. The agreement includes all the standard promises and guarantees you'd expect. Basically, everyone is promising to play nice and be honest, with some penalties if things go wrong. Banks like Barclays, Bank of America, Goldman Sachs, and Morgan Stanley are helping Las Vegas Sands sell these notes. They are the underwriters, meaning they are guaranteeing they can sell all the notes. These banks have worked with the company before and could again in the future. So what does all this mean? Las Vegas Sands is raising a significant amount of cash by selling debt. This could be for a number of reasons, like expanding their resorts, paying off old debts, or just having more money on hand for future opportunities. They are paying interest to raise the funds, which is not ideal, but the alternative is to sell ownership in the company, which is usually less desirable. It will be important to keep an eye on how Las Vegas Sands uses this money and whether it leads to increased profits in the future. Actor now, what's my take on all this? Las Vegas Sands is making a calculated bet. They're taking on more debt, which always carries risk. If their revenues decline, paying back these notes could become a struggle. On the other hand, if they use this money wisely to grow their business, it could pay off big time. The fact that big banks are involved suggests they believe in the company's ability to repay. The company's direction seems focused on expansion and maintaining its position in the competitive casino and resort market. A major risk is always economic downturns, which could hurt the amount of people willing to spend on gambling and resorts. A major opportunity is further expansion into new markets, especially in Asia. In conclusion, this move by Las Vegas Sands is a double-edged sword. It provides them with capital for growth, but also increases their financial obligations. Whether this is a good move will depend on the execution and the overall economic climate. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. Let me know in the comments what company you want us to decode next.